Most people think trading crypto is like this nonstop, adrenaline-fueled action movie.
Oh, totally. They picture the flashing green candles and the overnight millionaires.
Right, the absolute thrill of the chase. But according to the latest data from professional trading desks, I mean, if your heart is racing when you look at a chart, you are probably about to lose your shirt.
You are almost certainly going to lose it.
Yeah, exactly. Welcome to Bitcoin Deep Dives by MyCryptoParadise. And if you're listening to this right now, you're part of the Paradise family now.
Welcome to the family.
You've joined a community that is basically dedicated to one core philosophy above all else, which is protecting your capital, stepping out of the casino, and really mastering the mental game of crypto.
Because that mental game, honestly, it's entirely what separates the people who build generational wealth from the people who just, get completely liquidated.
So true. And today, we are diving deep into an exclusive behind-the-scenes strategy update from Simon. He's one of the lead traders on the Paradise team.
And this update is just gold. He breaks down current market conditions, sure, but more importantly, he really exposes the raw behavioral science of trading.
Right, the psychology of it all. Which brings us to the mission of this deep dive. We're unpacking his overarching point, which is incredibly counterintuitive.
Oh, yeah. It goes against everything Twitter tells you.
Exactly. Simon says that feeling bored is the ultimate sign that you are finally trading like a millionaire and chasing excitement. Direct ticket to bankruptcy.
It's so true.
Yeah,
I mean, if you're having fun every second, you're doing it wrong.
Okay, so let's unpack this. Because to understand why boredom is actually your strongest weapon, we have to understand the environment we're currently operating in.
Right, the macro backdrop.
Yeah. And Simon points straight to this specific metric, the World Uncertainty Index. And he notes that we are currently sitting at historical, unprecedented highs.
It is a fascinating data point, honestly.
Yeah.
Because for those unfamiliar, the World Uncertainty Index, it's not just a feeling, it's not a vibe.
Right, it's an actual quantifiable metric.
Exactly. Researchers actually track these quarterly reports from the Economist Intelligence Unit. They specifically analyze the frequency of the word uncertainty in close proximity to discussions of geopolitical events, economic policy shifts, global trade, stuff like that.
And right now, it's off the chart.
It's completely off the charts. Right now, this index actually surpasses the anxiety levels recorded during the COVID crash.
Wow.
Yeah, and the 2008 global financial crisis, even the dot-com bubble.
Okay, wait, I want to pause on that because when you say uncertainty, people might just assume you mean the evening news is depressing.
Sure, yeah.
But Simon is talking about the mechanical, physical effect that global anxiety has on capital, isn't he? I mean, how does a chart measuring the word uncertainty actually affect my portfolio?
Well, simply put, it dictates liquidity flow.
Okay.
Think about it. When institutional capital managers are facing this unprecedented lack of clarity about the future, massive amounts of money, they don't just sit in broad index funds.
Right, they get nervous.
Very nervous. The capital becomes incredibly erratic. It aggressively sloshes in and out of competing narratives.
Sloshes is a good word for it.
It's like a bathtub on a ship. Like currently, the artificial intelligence boom, right? That is acting as a massive but temporary magnet for liquidity.
Oh, for sure. Everyone's throwing money at AI.
Exactly. But simultaneously, you have these escalating global conflicts driving money wildly into and out of commodities like oil.
Right.
And on top of all that, persistent fears of a traditional banking crisis are pushing capital toward historical safe havens like gold.
So you basically have these massive, totally unpredictable tidal waves of money moving across the board.
Exactly.
So how does a professional trader at MyCryptoParadise react to that? Because Simon's response in this update, it's like a masterclass in emotional control.
It really is. It's all defense right now.
Yeah. We've been watching Bitcoin bounce wildly between, the $74,000, $76,000 marks.
It's been a roller coaster.
And retail traders are absolutely losing their minds trying to catch every little micro swing. But Simon is playing unbelievable defense. He explicitly states he's staying heavily in cash.
Cash is a position. People forget that.
Right. He's diversifying into USDT. And for anyone new to that term, USDT is Tether. It's a stable coin pegged directly to the US dollar.
It's essentially a digital safe harbor.
Exactly. He is literally sitting on his hands. He's waiting for either a massive drop to his magical target of $44,000 to reaccumulate, or he's waiting for undeniable 5-move bullish confirmations before he commits a single cent.
Because he absolutely refuses to be reactive.
Right.
In times of the highest historical uncertainty, liquidity is thin. It's entirely unreliable.
Meaning a small amount of money can move the price a lot.
Yes. A sudden 3% spike in Bitcoin's price might look like the start of a massive rally to an amateur. But Simon understands the mechanics underneath that.
It's just noise.
Exactly. That spike might not be a true market shift. It could simply be a temporary algorithmic rotation by a single hedge fund adjusting its risk parity.
Oh, wow. So aggressively following a single isolated bullish signal right now is basically a statistical death sentence.
Mathematically, yes, it is.
I gotta be honest, I struggle with this logic sometimes, and I know our listeners do too.
It's tough.
Because if the market is printing consecutive green candles and moving up, doesn't sitting in stablecoins mean we're like voluntarily missing out on profits?
That's the FOMO talking.
Right, but by the time a trend is quote-unquote undeniable, hasn't the smart money already made all the gains? Aren't we just buying their bags at that point?
I hear that all the time. But that is the exact psychological trap that trains retail accounts.
Okay, break that down for me.
Preserving your capital during times of high uncertainty is literally the only mechanism that ensures you survive to trade during times of high certainty.
Survival is the key.
Always. Simon's logic is rooted entirely in probability. When the macro environment settles down, when that world uncertainty index drops and the fog clears, that is when technical signals actually have a high mathematical probability of following through.
Okay, let's use an analogy here. Trading aggressively in this current market, it's like driving a sports car at 100 miles per hour into a wall of thick fog just because you saw a tiny gap in the mist.
I love that. That's exactly what it is.
Right. I mean, sure, you might make it through that one gap. You might even make it through two gaps. But eventually, the math catches up with you, and you are going to hit a tree.
A very expensive tree.
Yeah. Surviving the fog is infinitely more important than setting a speed record inside of it.
Which, honestly, pivots us perfectly from macroeconomics to pure behavioral science.
Let's go there.
Because surviving the fog logically requires slowing down, we have to ask why human neurology actually compels people to floor the gas pedal instead.
Right. Why do we do this to ourselves?
Well, Simon's assertion that professional trading should feel boring directly confronts the devastating impact of FOMO, the fear of missing out.
He notes in the update that he's watched this specific psychological phenomenon burn out experienced traders in literally every cycle since 2016.
Every single time.
Yeah.
It never fails.
Because humans are hardwired to seek dopamine. When you see a chart rocketing upward, your brain just bypasses logical risk assessment. It initiates this immediate get-rich-quick self-talk.
You start doing the math in your head.
Exactly. You start calculating how a 20% portfolio flip overnight could totally change your life.
And behavioral psychology gives us a term for why this is so dangerous. It's called variable ratio reinforcement.
Variable ratio reinforcement.
Yeah. It is the exact same psychological mechanism used in slot machines.
Oh, wow.
Think about it.
Yeah.
Sometimes a retail trader throws all logic out the window. They make a massive over-leveraged bet on a green candle, and they actually win.
They flip their portfolio overnight.
Exactly, which is the absolute worst possible thing that could happen to them.
Because it validates the bad behavior.
Precisely. That short-term luck creates a toxic, false feedback loop. The trader attributes a totally random outcome to their own genius.
I'm a trading god now.
Right. But Simon points out that a true trading strategy requires a full 3-year cycle to actually validate itself.
3 years, not 3 weeks.
Not 3 weeks. The 3-year benchmark isn't arbitrary either. It forces a strategy to survive a complete economic rotation.
Meaning all the different phases of the market.
Exactly. You have the euphoric, massive bull runs, the crushing, liquidity-draining bear markets, and the agonizingly slow, sideways crab markets.
Right, because anyone can make money when a chart goes straight up.
A monkey throwing darts can make money in a bull market.
Seriously. But professional strategies are engineered to protect you from your own neurological biases when the market inevitably turns against you.
That's the key. Protection.
So I want you, the listener, to really visualize this dynamic right now. If you open your exchange app on your phone, and you feel your heart racing, your palms sweating, or your stomach dropping, just stop. Yeah, you need to freeze and ask yourself a very hard question. Are you trading or are you gambling?
Such an important distinction.
Simon offers this incredibly blunt, powerful advice here. He says, if you want flashing lights, loud noises, and the thrill of the gamble, take your friends and go to a casino.
It's way more fun.
It's significantly more fun, the drinks are free, and it is mathematically much cheaper than revenge trading your crypto portfolio trying to catch a bottom that simply does not exist.
It's funny, but it's sad
Yeah.
because it's true. Our inherent need for excitement is a profound vulnerability in this space.
Yeah.
We desperately want the market to be a game we can beat through sheer enthusiasm and hustle.
Just grind harder, right?
Right. And when sheer enthusiasm fails, that desire to outsmart the game naturally leads people to look for technological shortcuts.
Oh, man. Here's where it gets really interesting. Because if human emotion, our own dopamine cravings and FOMO, is the ultimate enemy crashing our portfolios into the fog, the logical next step for the average person is to say, well, let's just remove the human entirely.
Let the machines do it.
Exactly. We are currently seeing a massive explosion of hype around AI trading bots. I mean, social media is flooded with ads promising these algorithms that will trade flawlessly for you while you sleep.
It is a highly compelling narrative. Who wouldn't want passive income while they sleep?
Right. But Simon provides a vital reality check here, grounded in actual structural market mechanics.
Yeah, the data shows that the retail AI trading bots currently being sold to the public actively underperform the broader market.
They lose money.
They lose money. The public fundamentally confuses consumer-grade algorithms with true institutional high-frequency trading.
Right. It's Wall Street infrastructure versus like a $20 monthly subscription app. Break down why that gap is so insurmountable for the listener.
Okay, so to successfully execute automated high-frequency trading, you are not operating on a standard laptop or a cloud server.
Definitely not a MacBook.
No. You're competing against multi-billion-dollar quantitative hedge funds. These institutions utilize proprietary hardware. We're talking field programmable gate arrays.
Wow.
They literally lay their own fiber optic cables just to shave microseconds off data transmission.
Just microseconds.
Microseconds. They physically co-locate their servers inside the exact same data centers as the crypto exchanges, purely to eliminate latency.
So they're operating in milliseconds.
Exactly. So for an individual retail trader to hand their capital over to a newly launched AI bot, a bot completely lacking a proven 3-year cycle track record, is to willingly become exit liquidity for those institutions.
That is terrifying. But Simon brings up a deeper, almost philosophical point about algorithmic trading that kind of shifts the entire perspective.
Yeah, he does.
He notes that even though bots are executing millions of microtransactions a second, the broader market remains fundamentally, unavoidably emotional.
It's a paradox, right?
It is. And the reason why is because human beings are still the ones writing the parameters. Human beings dictate the risk thresholds.
And this perfectly explains why traditional technical analysis tools still function so beautifully in a market dominated by machines.
Give me an example of that.
Well, Simon heavily utilizes the Fibonacci 1.272 retracement level as a primary resistance target.
Okay, wait, before we move on, let's clarify that for the listener because technical jargon can easily alienate people.
Good call.
When Simon talks about a Fibonacci retracement, we're talking about a mathematical sequence found everywhere in nature, right? From the spirals of galaxies to the proportions of the human body.
Exactly. It's built into the universe.
So in trading, it's a tool used to predict where a price might bounce back after a major move. But why does a natural mathematical sequence dictate where Bitcoin's price finds resistance?
Because the market is not a rational pricing machine.
Oh, okay.
It is a massive aggregated visualization of human fear and greed. The Fibonacci levels work because human psychology naturally exhausts itself at predictable mathematical thresholds.
So it's measuring our exhaustion.
Yes. A rally runs out of buyers at the 1.272 extension, not because of magic, but because that is the exact proportional level where the collective crowd feels the asset has become too expensive.
The urge to take profit overwhelms the FOMO.
Exactly. The bots are simply programmed to anticipate and react to these human psychological exhaustion points.
So the machines are not eliminating emotion.
Not at all. They are systematically amplifying our own panic and euphoria.
So if the bots are just a mirror reflecting our own anxiety, it means the algorithms aren't the predators we should be worried about.
No, they're just tools.
Which prompts the question, if the AI isn't the apex predator of the crypto jungle, who is?
The predator is the market maker. It's the institutional capital that weaponizes patience.
Weaponize patience. I like that.
And Simon's update explains exactly how this hunting mechanism works through the lens of the liquidation heat map. He essentially views the market structure as a predator hunting retail traders who operate on emotion.
The sheep, the retail traders who couldn't handle the boredom we talked about earlier.
Exactly. The ones who let variable ratio reinforcement take the wheel.
So how does the predator hunt?
Well, Simon's current data analysis reveals a massive, glowing cluster of long position stop losses.
Yeah.
And they're sitting aggressively around the $70,000 to $69,000 mark.
Okay, let's translate the mechanics of that heat map for the listener.
Sure.
When a retail trader takes a long position, they are basically betting the price of Bitcoin will go up.
Right.
But to maximize their dopamine, they use leverage. They borrow money from the exchange to make that bet 5 or 10 times bigger.
Which is where it gets dangerous.
Very. And a stop loss or liquidation point is the exact price target, where the exchange steps in and says, nope, you were wrong, the price drop, and we are forcibly selling your underlying asset to cover the money you borrowed.
They'll wipe you out.
Yeah. So when Simon looks at a liquidation heat map, he is literally looking at a radar showing millions of dollars in highly leveraged, highly emotional bets, all clustered together at that specific $69,000 range.
It's a target on their backs. And Simon corroborates this vulnerability by tracking open interest.
What's that tell him?
Open interest measures the total number of outstanding derivative contracts that remain unsettled. Right now, Simon points out that open interest is rising in tandem with the price of Bitcoin.
Okay, and why is that combination so dangerous?
Because it tells a very specific mechanical story. It indicates that the upward price action isn't being driven by spot buying.
Like people actually purchasing and holding the real asset.
Exactly. It's not real conviction. It's being driven by leverage. Overly greedy retail traders are piling in, opening weak, borrowed money positions. They are basically building a fragile house of cards.
Okay, so instead of the old cliche about wolves and sheep, think of this like a game of tactical bowling.
Bowling. Okay, go on.
Yeah, the market makers, the whales with massive capital, they're the bowlers. The leveraged retail traders are the pins.
Oh, I see where you go.
The market makers are always looking for the densest cluster of pins because knocking them down requires the least amount of energy.
That makes perfect sense.
Right. If they want to acquire cheap Bitcoin, all they have to do is apply a little downward pressure on the price, pushing it toward that $69,000 mark.
Just a little nudge.
Exactly. And once the price hits that cluster, the exchange forcefully triggers all those stop losses. It creates an automatic cascade of forced selling, driving the price down even faster, which allows the whales to scoop up the asset at a massive discount.
It's structural mathematical bowling.
Yeah,
Well,
it is entirely calculated extraction.
and this mechanism is exactly why Simon's strict technical rules are non-negotiable. He analyzes the heat map, he sees the fragile open interest, and he actively refuses to participate in the vulnerable cluster.
He won't play their game.
Right. He details a common retail scenario where a trader takes a long position, places their protective stop loss, say 6% below their entry price, but their realistic take-profit target is only 2 to maybe 10% above.
Wait, risking 6% to potentially make 2%.
Yes, people do it all the time.
That is the definition of a mathematically bankrupt strategy. You are literally risking $3 to make one.
It's insane.
I mean, you might get lucky 3 or 4 times in a row, but over a sample size of 100 trades, that negative risk-to-reward ratio will inevitably drain your portfolio down to 0.
Exactly. It completely violates the core philosophy of professional capital management, which is to optimize every single decision for longevity.
Longevity over quick flips.
Always. A professional like Simon isn't hunting for a quick, stressful 2% scalp in a highly uncertain, fog-filled environment.
So what does he look for instead?
He waits for structural volume confirmation. He specifically watches for the price to drop while the trading volume simultaneously declines.
Meaning what?
It's a mechanical signal that the aggressive sellers are physically running out of assets to dump.
Okay.
And he also incorporates the Elliott wave principle, which essentially analyzes crowd psychology as moving in 5 distinct impulsive waves, followed by 3 corrective waves.
So he views the market organically.
Yeah, he views it as an organic entity that must constantly breathe in and breathe out.
The market breathes in, expanding upward in price, and then it is mathematically required to breathe out, pulling back to consolidate.
You can't just breathe in forever.
Exactly. So trading aggressively on a green candle in this current market, it's like watching an Olympic weightlifter. Imagine a massive guy straining under a huge barbell, mid-exhale, veins popping.
Right.
You do not run up and try to hand them an extra 50 pounds.
No, that would end terribly.
But that is exactly what retail traders do when they buy the absolute top of a rally.
Yeah.
They are handing heavy bags of capital to an exhausted market. You have to wait for the reset. You wait for the weightlifter to drop the bar, catch their breath, and find their natural rhythm again.
Professionals wait for the market to fully exhale before they deploy capital.
Yes. And that mandatory waiting period is exactly what feels so agonizingly boring to an amateur.
But it feels structurally safe to a professional.
Exactly. The amateur is sweating, obsessively staring at a 5-minute chart, praying that the algorithmic bot they bought will trigger a breakout.
And meanwhile, the professional from the Paradise team is completely in cash.
Just chilling.
Just chilling. Emotionally detached, knowing that the high probability setup hasn't actually manifested yet. Simon knows the leverage pins are going to be knocked down, and he's entirely content to sit on the sidelines, preserving his capital, waiting for the dust to settle.
Waiting for his execution at that $44,000 target or on a confirmed structural breakout.
Exactly.
This entirely reframes what it means to be successful in the cryptocurrency space. And this framework we've been talking about, this is the beating heart of the MyCryptoParadise mission.
It really is.
It is about actively transforming gamblers into disciplined, risk-focused professionals. Because being part of the Paradise family means making a conscious choice to step away from the chaotic, dopamine-driven noise of crypto social media.
Step out of the casino.
Step away from the casino mindset entirely and step into a rigorous framework of emotional control. Because trusting a proven, mathematically sound system, rather than trusting your adrenaline, is literally the only way you achieve true financial peace of mind.
Absolutely. And to cement this methodology, Simon ends his strategy update with a daily mantra.
Oh, I love this.
It's great. It's a psychological anchor that every single trader needs to internalize before they ever even look at a chart.
Let's hear it.
He says, thinking probabilities, not emotions. Remaining calm and disciplined in every market condition. Respecting risk management and protecting capital above all else. Losses are feedback that sharpens strategy, and wins are the result of discipline.
I want to focus on that transition there, moving from a mindset of luck to a mindset of data.
Yeah.
Because in the casino, losing a hand of blackjack is just bad luck. You blame the dealer, you blame the deck. But in a professional trading system, a loss is purely informational data.
Just feedback.
Exactly. It illuminates exactly where your structural system or your personal psychology broke down.
It is the ultimate tool for removing the ego from the equation. The market isn't malicious, it isn't out to get you personally.
It doesn't care about you.
It doesn't. It is simply a mechanism providing neutral mathematical feedback on your execution.
We have covered a massive amount of ground today. We've talked about how human emotion drives the physical movement of capital, how the fog of global uncertainty forces us to play defense, and how the machines, the AI bots, simply amplify our own panic and greed.
It's a wild ecosystem.
It really is. But as you walk away from this deep dive, we want to leave you with a final, lingering question to ponder.
Something to think about.
Yeah. Simon says that losses are just feedback. So, looking back at your own portfolio, what vital piece of feedback is your last painful loss desperately trying to teach you right now?
That's a powerful question.
Think about that the next time you look at the charts. Welcome to the Paradise family. We will see you on the next deep dive.